Growing your retirement savings isn't just about picking the right investments. It's also about how do you hold those investments. See, many people don't realize that the type of account that you use can actually make a difference in what you keep versus what you owe in taxes. Now, that's exactly what one real estate investor here discovered. See, by leveraging the right retirement account, she bought a property at auction and turned it into a 91% return on investment. Hey everybody, I'm John Bowens here at Equity Trust, and in this episode of Getting Real, we're going to take a closer look at how converting to a tax-advantaged retirement account like a Roth IRA can make a massive impact on your investments. And we're also going to talk about what are the considerations to make before making a move like this. So let's take a look at Kay's story and how she turned a real estate investment into a huge return, all tax-free. Before we do that, if you haven't already, make sure to subscribe to the Equity Trust YouTube channel and hit the bell icon so we can alert you to all of our upcoming video content. So Kay, she's a speech therapist in California, and she spent many of her years saving for retirement, just like most Americans, which is investing in the traditional financial markets. But see, she then understood that real estate investing could offer her a better opportunity to create and preserve wealth. And at that same time, she learned that not only could she invest in real estate with non-IRA funds, but she could also invest in real estate with her retirement funds. So she had saved all of this money over all of these years working as a speech therapist, and then she uncovered that she could actually invest in real estate with her retirement savings accounts. So she used her retirement account to purchase a property at auction for $65,000, and she planned on rehabbing it and selling it for a profit. And her plan worked out well. After the renovations, she sold the property and made a 91% return on investment. And that, of course, all flowed back into her self-directed IRA, exempt from taxation. But here's what made the deal even better. It was because how she structured the retirement account transaction, she didn't owe any taxes at all on the profit. You're going to learn about this. It's called a Roth IRA. So rather than letting the IRS take a cut, she used the proceeds in her IRA to then buy a duplex, which now brings in $1,700 per month in tax-free rental income. So she used the profits from the fix and flip transaction and rolled it into a cash flowing asset. Not all retirement accounts work the same way. And that's why many investors choose to move more of their funds into a Roth IRA to take advantage of tax-free growth and tax-free withdrawals in their retirement. I like to call this compounding interest in the absence of taxation. So what makes a Roth IRA different, and why do some investors convert their funds from a traditional or pre-tax account to a Roth account? Well, let's break it down. Number one, pay taxes now rather than paying later. Sometimes you'll hear the analogy used, either pay taxes on the seed or on the crop. A traditional IRA or 401k allows tax-deferred growth, meaning you won't pay taxes until you withdraw the money. A Roth IRA, on the other hand, is the opposite. It requires you to pay taxes up front when funds are put into the account. That could be either through contributions or through a conversion from a pre-tax to a Roth account. And then going forward, all of your growth is tax-free, and as long as you're following all of the rules and guidelines, all of your distributions are 100% tax-free. So rather than partnering with the IRS like you would with a traditional IRA, where you eventually have to pay taxes when you take the money out, with a Roth IRA, you eliminate the partnership. Thus, all of your distributions during your retirement years are 100% tax-free. All right, number two, no taxes on future gains. So think about compounding interest in the absence of taxation. Just like in Kay's example, she did a fix and flip transaction. She had tax-free profits flowing back into a Roth IRA. She then redeployed that capital into a new rental property, and all of the cash flow is 100% tax-free. So tax-free gains compounding year over year over year, and then tax-free distributions. Now, number three, this is something a lot of people don't think about. With pre-tax accounts like traditional IRAs, there are what are called required minimum distributions. Right now, it starts at the age of 73. Eventually, by 2033, it'll be 75 years of age. Required minimum distributions. With pre-tax accounts, you're forced to distribute a certain percentage based on your life expectancy every single year. But with a Roth IRA, no required minimum distributions in your lifetime. That means more years to compound your growth tax-free, which could potentially mean more money for your children or grandchildren to inherit 100% tax-free as well. Number 4, tax-free withdrawals in retirement. So once you reach the age of 59 and a half is the qualified retirement age. There is also, you'll learn with a Roth IRA, something called a 5-year seasoning period. So once the account is seasoned for 5 years and you're 59 and a half, now all of your withdrawals from the Roth IRA are 100% tax-free. Now you'll find some people are told that they're not allowed to contribute directly to a Roth IRA because their modified adjusted gross income is too high. There is a solution for some folks, and that is called a backdoor contribution. This is where you contribute first to a traditional IRA and then immediately convert over to a Roth IRA. So you'll want to team up with your CPA or your tax accountant and discuss your specific income situation and determine, do you need to utilize this backdoor contribution approach? So whether through direct contributions to a Roth IRA or a conversion, moving funds into a Roth IRA can potentially put you in an advantage long-term in creating compounding interest in the absence of taxation. A couple things to consider with your tax accountant or CPA. Converting in stages from traditional to Roth. That would be converting over multiple years to spread out your tax burden. Or converting transaction specific. So when the right opportunity presents itself and you feel strongly about the return on investment, you might be able to mathematically determine that it makes more sense to convert now, pay the taxes on the smaller seed, so you're not paying it on the much larger crop. And that's exactly what Kay did in this scenario. She converted funds, acquired a property, made a profit, and then bought another rental property, and now she has over $1,700 in net tax-free cash flow coming into her Roth IRA on a monthly basis. To learn more, check out in the comments section, we have a link to our self-directed real estate master course. This is a course that has video content that will provide to you a deep dive into some of the things that we talked about and much more. Check out the comments section. You'll see we have a code called Getting Real. Until the next one, keep leveraging compounding interest in the absence of taxation. Thanks for watching. If you enjoyed this video, don't forget to hit the subscribe button right here so you never miss out on new content. And if you're ready to dive deeper, check out our other videos and resources right here.